Section 1. The Fantasy and the Trap. Imagine this situation, because it is the biggest American dream. You are 45 years old. It is a regular Tuesday evening. You sit down at your kitchen table with a glass of wine and your checkbook. You write a single check for $42,000. It is the last of your savings. It is the scraping of your emergency fund. It is the last bit of a small inheritance, but it feels incredible. You put that check in an envelope, you mail it to the bank, you take a very deep breath. You have finally done it. You have paid off your mortgage completely. You own your home, free and clear. The deed is 100% yours. A huge wave of relief washes over you. You sleep better that night than you have in years. You believe you just made the safest, smartest, most responsible choice of your life. But now fast forward just 6 months. You lose your job suddenly. The economy turns bad and your whole industry is gone. You have zero income coming in. You look at your bank account and it is completely empty. You sent all your available cash to the bank to pay off the house. Now you need to buy groceries. You need to pay the electric bill. You need to fix the transmission on your car. You look around at the walls of your home. You know there is $500,000 of equity trapped inside these walls, but you cannot eat drywall. You cannot pay a mechanic with a brick. You go to the bank to ask for a home equity line of credit, and they basically laugh at you. They say we cannot lend to you. They say you do not have a job. You are sitting inside a pile of gold, and you are starving to death. This is called the liquidity trap. By obsessing over being debt-free, you have mathematically guaranteed your own fragility. You traded your liquid options for a gold star on a credit report, and by doing that, you lit hundreds of thousands of dollars of future wealth on fire. Section 2. The emotional lie. My name is Cool Joe, and I think way too much about the emotional lies that hurt our finances. If you are someone paying an extra $500 a month on your mortgage because you want that feeling of freedom, or if you have a low interest rate but still feel guilty about your debt, please hit that subscribe button. Give this video a thumbs up if this helps you. Because today, we are going to challenge one of the most sacred rules in personal finance. We are going to talk about why paying off your mortgage early is often a mathematical disaster. We will look at the idea of dead equity. We will look at the power of inflation arbitrage. And we will see why keeping your mortgage might actually be the safest choice you can make. Here is the truth about the pay off your mortgage movement. It is driven by emotion, not by math. It is driven by a deep fear of debt that comes from our grandparents' generation. Back in the 1930s or the 1980s, interest rates were very high. Paying off debt back then was simply about survival. If your mortgage rate was 14%, paying it off was a guaranteed 14% return. That was an easy decision. But we live in a completely different world today. Even with rates changing, if you have a mortgage at 3 or 4 or even 5% and you are paying it down early, you are basically putting your money into a savings account that pays 3 or 4 or 5%. That is your return for paying off the debt, the interest you save. Now ask yourself a question. Would you voluntarily lock your money in a savings account that pays only 3%? A savings account with a huge penalty for taking the money out early? No, you would not do that. You would say that is a terrible investment. You would say I can get 5% in a money market fund right now. You would put that money in the S&P 500, which has historically returned 8 to 10%. By paying off your mortgage, you are choosing a 3% return over a 10% return. You are accepting a lower yield on your money because the word debt makes you nervous. You are paying a fear tax, and it is a very expensive tax. Section 3. The power of arbitrage. Let us talk about the concept of arbitrage. This is how banks make their money, and it is how you should think to build wealth. A bank borrows money from you through your savings account at 0.5% interest. Then they lend that same money back to you as a mortgage at 6% interest. They keep the difference, and that is their profit. You can do the exact same thing but in reverse. If you have a mortgage at 4% and you can invest in the market at 8%, that 4% spread is your profit. It is free money created by using leverage. Let us use real numbers to make this clear. Say you have $100,000 in extra cash. You can either pay off $100,000 of your 4% mortgage, or you can invest that same money at 8% in the market. If you pay the mortgage, you save $4,000 a year in interest. If you invest the money, you earn $8,000 a year. The difference is $4,000 a year, and that money compounds year after year. Over 30 years, That single decision to invest instead of pay off debt is worth hundreds of thousands of dollars. By paying off the house, you are killing the arbitrage opportunity. You are firing your most productive employee, which is leverage, and you are deciding to do all the hard work yourself. Redefining risk. Now you might be thinking, but cool Joe, debt is risky. What if the market crashes? This is where we need to redefine what risk actually means. Most people think risk is owing money to someone else. I believe risk is not having access to money when you need it. This is called liquidity risk. When you pay extra on your mortgage, that money disappears into your home equity. Equity is dead money. It produces no cash flow. You cannot spend it. It just sits there doing nothing. You can only use it if you sell the house or borrow against it. But borrowing against it is very hard when you are in financial trouble. Banks only lend money to people who do not really need it. If you lose your job, or your credit score drops, or the housing market falls, that equity is trapped. You are house rich, but you are cash poor. Now compare that to someone who kept their mortgage. They put their extra money into a regular brokerage account instead. If they lose their job, they can simply sell some of their stocks. They could pay their mortgage for 5 years using their liquid assets. So who is actually safer? The person with the paid off house and zero cash in the bank, or the person with a mortgage and $500,000 in their investment account? The person with the cash is safer every single time. They have options, they have a safety net. The person with the paid off house has a roof, but they have no engine. If they cannot pay their property taxes, which you still owe even with no mortgage, the county can take the house anyway. So the idea that a paid off house guarantees security is a myth. Cash guarantees security, liquidity guarantees security. Paying off your mortgage destroys your liquidity, and that is a dangerous move. Inflation is your friend. This gets really interesting when we look at inflation. Inflation is the enemy of someone who saves cash, but it is the best friend of someone who has debt. When you take out a 30-year fixed-rate mortgage, you lock in your housing cost for 3 decades. Your principal and interest payment never changes, but the value of the dollar goes down every year. In 2025, your payment might be $2,000 a month. That feels like a lot of money. It might be 25% of your income. But by the year 2045, because of just 3% annual inflation, that $2,000 will have the buying power of about $800 today. Your income will likely have doubled or tripled by then. You will be paying off that loan with much cheaper dollars. The bank is the one losing in this deal. They lent you valuable dollars in 2025, and you pay them back with less valuable dollars in 2045. By paying off your mortgage early, you destroy this advantage. You are paying the bank back with your valuable dollars today, instead of paying them back with cheap dollars in the future. You are giving the bank a gift. You should drag that loan out as long as you possibly can. Let inflation eat away at the real value of your debt. Your mortgage effectively gets cheaper every single year, and you do not have to do anything. Section 6. The hidden cost of your payments. Let us talk about the opportunity cost of those extra mortgage payments. This is the invisible wealth you never get to see because you destroyed it. Say your mortgage payment is $2,000 a month. You decide to be aggressive and pay an extra $1,000 a month. You want to pay off the house in 15 years instead of 30. You feel very virtuous. You feel like a financial expert would be proud of you. But let us look at the alternative path. If you took that extra $1,000 a month and you invested it in a low-cost SP 500 index fund for those same 15 years, assuming the historical average return of 10%, you would have about $400,000. But wait, it gets better, because you did not pay off the house. You keep the mortgage for the full 30 years, so you keep investing that $1,000 a month for another 15 years. At the end of 30 years, your investment account is worth nearly $2 million. Meanwhile, the responsible person who paid off the house early, they have a paid-off house, maybe worth $800,000. The house appreciates in value regardless of the mortgage, and they have zero in their investment account. The difference in net worth is over $1 million. The decision to rush your mortgage payment cost you $1 million. That is the incredibly high price of your peace of mind. Section 7. The psychology of a paid-off house. Here is what most people do not realize about the psychology of a paid-off house. We think it unlocks freedom. We think once the house is paid off, I will start investing. But life does not work that way. Parkinson's law kicks in. When you no longer have that big mortgage payment, you usually do not invest that money. You upgrade your lifestyle instead. You buy a nicer car or a boat. You go on more expensive vacations. You absorb the extra money into your daily spending. By keeping the mortgage, you enforce a forced savings discipline, not in your house equity, but in your budget. Having that payment keeps your lifestyle spending in check. It allows you to deliberately invest your surplus cash elsewhere. Furthermore, having a paid-off house puts a big target on your back for lawsuits. If you get sued and you have 100% equity in your home, that is a juicy asset for a creditor. If you have a mortgage for 80% of the home's value, there is very little equity for anyone to take. The bank technically owns most of the house, and that acts as a form of asset protection. You look poor on paper. You have high debt. That makes you unattractive to people who file lawsuits. Meanwhile, you keep your real wealth liquid and hidden in your brokerage accounts. Addressing your fears. Now, I know the counter-arguments. I can hear the comments already. Cool, Joe, you are not factoring in risk. What if the market is flat for 10 years? What if I retire and I cannot make the payment anymore? These are valid emotional concerns, but they are solved by the liquidity buffer. Remember, in the investing scenario, you have a huge pile of liquid cash growing on the side. That pile is your risk mitigation tool. If the market is flat for a while, you still have all the principal you invested. If you retire, you can use the investment income to pay the mortgage. You can create your own synthetic payoff. If you have $500,000 in investments earning 4% in dividends, that is $20,000 a year, and that money can pay your mortgage for you. You are mathematically debt-free because your assets cover the liability, but you keep control of your principal. That is true financial independence. Handing your principal to the bank means you lose control. It means you are asking for permission to live in your own house. The only time, and I mean the only time, it makes sense to pay off a mortgage early is if your interest rate is much higher than what you can earn. If your mortgage is 8 or 9% in a high-rate environment, then yes, pay it down. That is a guaranteed high return. Or if you know you cannot save money, if you know you will spend any extra cash on toys, and pay the mortgage because it acts as a forced savings account. But if you are watching this channel, I assume you are disciplined. I assume you want to optimize your money. For the disciplined investor, a low-interest mortgage is an asset. It is a relic of a low-interest era we may never see again. Paying it off early is destroying a valuable financial tool. You are throwing away a below-market loan that lets you leverage your wealth. Section 9. Changing your mindset. This requires a big shift in your identity. You have to stop viewing debt as a sin. Debt is a tool, a financial instrument. Corporations use debt. Governments use debt. Wealthy people use debt. They use it to amplify their returns. They use it to maintain liquidity. Only the middle class is taught that all debt is evil. We are taught to rush to a net worth of zero. But zero is a dangerous place to be. Zero leverage means zero amplification of your wealth. Zero liquidity means you have zero options when life goes wrong. Section 10. Your action plan. So here is your actionable step starting right now. Stop making those extra mortgage payments. Take that extra $200 or $500 or $1,000 you send to the bank each month. Open a separate brokerage account and call it your Freedom Fund. Set up an automatic transfer for that same amount into an SP 500 index fund. Then just watch that account grow. In 10 years, compare the balance in that investment account to the amount of interest you would have saved on your mortgage. You will see the math with your own eyes. You will see that you are tens of thousands of dollars richer already. And more importantly, if you have an emergency tomorrow, you can actually access that money. You cannot access the extra payment you sent to the bank last month. That money is gone forever. We need to stop optimizing for a good night's sleep based on old, outdated logic. We need to start optimizing for a good night's sleep because we have a fortress of liquid cash. A cash fortress that can handle any crisis life throws at us. A paid-off house is just a trophy. It sits there and looks nice. A massive liquid investment portfolio is an army. It protects you and works for you. I would much rather have the army. If this video made you pause your extra mortgage payment, please share it with a friend. Help them see the math behind the myth. Thanks for watching, and I will see you in the next video.